Welcome to Breaking News to Trading Moves.
It's good to be here.
We are looking squarely at the telecommunications sector today. It's a space that's always in motion, but we've got a specific event to focus on.
Right. We're looking at Verizon.
Exactly. We're focusing on Verizon's latest financial reporting. The company released its Q4 results, and the market reaction has been quite distinct.
It certainly has. When a company of that size reports, everyone pays attention. And if we look at the data coming out of this report, what we're seeing is, well, you could characterize it as a bullish telecom reset.
A reset. That's a strong way to put it.
I think it fits. When you look at the different pieces of the report, it suggests a change in the status quo. It's not just business as usual.
So let's break that down. When you say reset, you're talking about what? We're looking at an earnings beat, for one.
An earnings beat, yep. Some subscriber growth numbers that, frankly, we haven't seen from them in a while.
Okay, that's a big one.
A very big one. Then there's their guidance for 2026, which looks ahead. And, maybe the loudest signal of all, a rather large share buyback plan.
Right. Putting your money where your mouth is.
Precisely. So the mission here is to examine those numbers, really understand the strategic adjustments Verizon seems to be making, and then, map out the resulting winners and losers in the market.
Because this isn't just about one company's report. It's about how those results influence the broader landscape. One company's move forces everyone else to react.
Absolutely. It changes the competitive dynamic for everyone in the sector, from their direct competitors to their suppliers.
Okay, let's get right into them. The numbers and the narrative. I think we have to start with the Q4 earnings breakdown. What are the headline figures that everyone is looking at first?
Well, the first number to circle, the one that always gets the initial focus, is the adjusted EPS, or earnings per share.
The bottom line.
The bottom line. And for Q4, Verizon reported $1.09.
109. And on the revenue side, the top line.
Revenue came in at $36.4 billion.
$36.4 billion. Now, context is everything with these figures. How does that compare to what the street was looking for? What were the expectations?
And that's the key question. These results beat expectations. Both of them. It wasn't a massive blowout beat that makes you rethink the entire industry, but it was a solid, clear beat on both fronts.
So better than anticipated.
Right. And that's the primary takeaway from the headline numbers. You have to remember, the market had a certain set of assumptions baked into Verizon's stock price. A certain level of performance was expected.
And they cleared that bar.
They cleared those hurdles. And when a company of this size, in a mature market like telecom, clears expectations, it sends a very specific signal about operational stability. It suggests they're managing their business effectively in a tough environment.
It says the ship is steady.
The ship is steady, and maybe even picking up a little speed.
But the earnings and revenue, as you said, they're the result of the operational performance. The engine driving all this, especially in the world of telecom, is subscribers.
Always. You can manage costs all you want, but you have to be growing your customer base.
So let's talk about that subscriber momentum.
This is where the report gets very specific, and I think where most of the positive reaction came from. We need to look at a metric called postpaid phone net adds.
Okay, let's define that for a second. Postpaid means customers on a contract, not just prepaid cards. The higher value customers.
Exactly. These are the customers who sign up for 1- or 2-year plans, they have good credit, and their monthly bills are higher. It's often considered the vital sign for a wireless carrier. It tells you if the core of your business is healthy and growing.
So what was the number?
Verizon reported 616,000 postpaid phone net adds.
616,000, just for the fourth quarter.
Just for Q4. And that number seems to have caught a lot of people by surprise. It seems like a very high number compared to their recent quarters.
It is. It is a high number for them. In fact, if you look back, it's the strongest quarterly growth they had in years.
Oh.
Yeah. For a long time, the whole narrative around Verizon was that they were losing ground to competitors, particularly T-Mobile.
Right, that they were the incumbent, the big guy, but they were bleeding subscribers, or at least that their growth had completely stalled.
Police stalled. They were playing defense.
Yeah.
But posting a number like 616,000, that directly challenges that narrative. It doesn't erase it overnight, but it forces you to reconsider.
It suggests they're back on offense.
It does. It suggests that they're finding ways to bring customers in the door and, just as importantly, keep them there. Something in their promotional offers or their network messaging is starting to connect with consumers again.
And it wasn't just phones, was it? I believe the report also mentioned broadband. That's right. And this is a crucial piece of the puzzle because it speaks to their broader strategy. The broadband ads were also solid.
So home internet.
Home internet, yeah. Using their 5G network for what's called fixed wireless access. This is so important because the game isn't just about the handset in your pocket anymore.
It's about the entire connectivity bundle.
Whole ecosystem. It's about the internet connection in your home, your phone, maybe even your car down the line.
Yeah.
If they are growing both the mobile side and the home broadband side, it implies their bundle strategy is working.
Or at least that their pitch about network reliability is resonating across different products. People trust the brand for their home internet, too.
That's the idea they're selling. And these numbers suggest it's gaining some traction.
Okay, so that's a look back at the quarter that just ended. But the report didn't just look in the rearview mirror. They gave us a look at the future with their forward guidance.
Yes, and this is where management gets to set the tone for the coming year. They provided an outlook specifically for 2026.
And what are they telling us to expect? What's the key metric there?
They again focused on the bottom line. They provided adjusted EPS guidance for 2026. The range they gave is $4.90 to $4.95.
$4.90 to $4.95. Again, back to our key question, context. How does that sit with what analysts were predicting for them for 2026?
It came in above street expectations.
Above, okay, that's telling.
It's very telling. Usually when you have a company that's been in a tough spot or is trying to execute what we called a reset, you might expect them to guide conservatively.
You mean set the bar low so they can easily step over it next year?
Exactly. Manage expectations downwards. But here, they're doing the opposite. They are setting the bar higher than what the market anticipated.
So what does that signal to you?
It signals a degree of confidence from the management team. They're essentially telling the market that the momentum we just saw in Q4 with those subscriber numbers isn't a fluke. They believe it's sustainable and will translate to the bottom line.
They're saying this is the new baseline.
This is the new baseline, and we're going to build from here. It's a confident posture.
And speaking of confidence, there is perhaps no louder signal of management's confidence in their own cash flow than a share buyback.
Exactly. And this is the fourth pillar of this report, and it's a big one. The shareholder returns.
What did they announce?
Verizon announced a plan for up to $25 billion in buybacks over the next 3 years.
$25 billion, with a B. That is a substantial amount of capital to be returning to shareholders.
It's a huge number. It shows a real commitment to capital returns. And they didn't just leave it as a vague 3-year plan. They have an immediate plan within that.
A more concrete target for this year?
Yes. They've said that at least $3 billion is planned specifically for 2026.
So the market knows that at least $3 billion is coming back this year, with the potential for much more after that.
Correct. It puts a tangible number on their capital return plan for the immediate future.
So let's put this all together. We have the earnings beat on the top and bottom line. We have that really strong subscriber growth number. We have forward guidance that's above expectations. And we have this massive buyback announcement. What is the ultimate investor sentiment signal here?
The signal, if you just look at how the stock reacted, is that investors are accepting the message. They're buying into the story.
And what is that story distilled down?
The story is that the market now believes Verizon can achieve growth, adding those 616,000 subscribers without completely wrecking their finances, without compromising their cash flow.
So that's the classic fear, that growth is too expensive.
It's always been the fear in this industry, that to get those customers, you have to offer huge phone subsidies, cut your prices, and spend a fortune on marketing, and in the end, the new customers aren't even profitable.
Right. Empty calories, so to speak.
Exactly. This report argues that they can walk and chew gum at the same time. They can grow the user base and still generate enough cash to fund the business, pay their dividend, and buy back stock. That's the message the market is latching onto.
It's a message of balanced, profitable growth, not just growth at any cost.
That's the ideal narrative, and for now, it seems to be working.
However, nothing in this market comes for free. There's always a catch, or at least a trade-off, that leads us directly to the trade-off and the market mechanics.
Yep. We have to talk about how they got those subscribers.
Right. As we said, you don't add 616,000 postpaid phones in a single quarter by just sitting back and waiting for the phone to ring.
Not in this market. You do it through being competitive.
Yeah.
And that introduces what we can call the price war factor.
We're seeing a much more promotional environment out there. You see the ads everywhere.
We absolutely are. And the risk that's being identified here is that stronger promotional intensity from Verizon was necessary to gain those subscribers.
So better deals on new phones, more aggressive trade-in values, maybe bundling in streaming services for free.
All of the above. And when the biggest player in the room, or one of the biggest, starts turning up the promotional heat, it changes the physics of the entire market.
And the consequence of that isn't just isolated to Verizon's own profit and loss statement.
No, not at all. It creates a potential chain reaction, an action and reaction. It can reignite fears of a price war across the entire wireless sector,
A race to the bottom.
or at least a race to lower profitability. If Verizon is being very aggressive to win a customer, their competitors, AT&T and T-Mobile, have a choice to make.
Do they match the aggression to defend their existing customers, or do they let some customers go to protect their margins?
That's the classic dilemma, and there's no easy answer. But often, the instinct is to fight back, to match the promotions.
So the ultimate impact here is really about margins for everybody.
Exactly. That's the fear. The fear is potential pressure on margins for the entire group. If everyone is forced to lower prices or increase those device subsidies just to compete for the same relatively fixed pool of customers,
Then what happens?
well, your revenue might go up or your subscriber counts might look good for a quarter or two, but the profit you make per subscriber, the margin could get squeezed.
So you're working harder for less money.
That is the trade-off the market is weighing right now. On one hand, you have Verizon showing strong growth, which is good. On the other hand, there's the question of whether that growth is coming at a cost that will eventually hurt the profitability of the whole industry.
A delicate balance. Okay, let's move on to how this translates to specific stocks. This is the trading moves part of the conversation. We need to look at the winners. Who benefits from this kind of setup?
Right, so the analysis categorizes the winners into three distinct buckets. And the first category is, perhaps a bit counterintuitively, the big wireless carriers themselves.
Wait, that does seem counterintuitive. We just spent all this time talking about the risk of a price score and margin pressure. How can they be winners?
It does seem that way, but you have to look at the rationale from a different angle. The rationale here is improved sentiment around two things: demand durability and churn control.
Okay, break that down. Demand durability.
It just means that the demand for high-quality wireless service is strong and not going away. Verizon's beat and those strong subscriber adds, they suggest that people are still willing to pay for premium connectivity. The demand is durable. It's not falling off a cliff.
And churn control.
Churn is just the industry term for customers leaving. Verizon's numbers suggest that these big companies can control churn. They can keep customers from leaving, even in a competitive market.
So a rising tide lifts all the big boats. The idea is that a healthy Verizon implies a healthy sector overall.
To some extent, yes. And the specific dynamic, connecting back to what we talked about earlier, is the cash flow. The combination of an earnings beat and strong ads suggests that cash flow-backed returns are sustainable.
Meaning the dividends and the buyback.
Exactly. Investors in these big telecom stocks love the dividends. They're often held for income. So if the core business looks healthy enough to support and maybe even grow those returns, the stocks become more attractive across the board. The fear of a dividend cut recedes.
So the tickers mentioned here are obviously Verizon itself.
Correct. That's VZ for Verizon.
And also AT&T.
Also T for AT&T. Even though they are direct competitors, and we'll talk about them on the other side of the ledger too, AT&T can fall into the winner bucket from this specific sentiment perspective.
Because a stable, growing Verizon suggests a stable, rational market where the big players can coexist and generate cash.
That's the bull case for the group, yes.
Okay, that makes sense. Let's look at the second category of winners. Tower REITs.
This is more of a derivative play. It's not a direct carrier, but a supplier to them. The rationale here is all about network load and densification.
Can you explain the mechanism there? How does Verizon adding subscribers help a company that owns cell towers?
Certainly. It's a pretty direct link. If carriers like Verizon are successfully pushing for subscriber growth, and if they're expanding their 5G and fixed wireless services to serve those customers, well, that puts more data traffic onto the network.
More people using more data.
More people streaming more video, playing more games, connecting more devices. All that traffic has to be carried. And more subscribers and more data usage requires more network capacity.
And that capacity comes from the equipment on the towers.
Precisely. That supports long-cycle leasing demand for macro towers. The carriers have to go to the tower companies and say, we need to add more antennas, or we need to upgrade our equipment on your tower, or even We need you to build a new tower in this growing suburb. And all that means more revenue for the tower owners.
So the tower owners benefit directly from the carrier's need to serve all these new customers and the data they consume. Their business model is validated by the carrier's success.
That's it, exactly. It's a landlord-tenant relationship, and the tenants are healthy and need more space.
So what are the tickers for this group? Who are the big players here?
We are looking at AMT, which is American Tower, one of the largest in the world, and SBAC, representing SBA Communications.
AMT and SBAC. Okay, now, what's the third category of winners?
The third bucket is network and optical equipment.
So we've gone from the carriers to the towers they use, and now we're going even deeper into the infrastructure.
Right. This relates to the plumbing behind the towers, all the gear that connects the towers to each other and to the rest of the internet. The rationale is leverage to fiber and overall traffic growth.
Okay, explain that mechanism.
Well, just like with the towers, all that increased data traffic has to go somewhere. An increased focus by Verizon and others on broadband and fiber, along with just higher data consumption in general, supports the need for upgrades.
Upgrades to what specifically?
You need better transport equipment, you need faster and smarter routing hardware, and you need more optical capacity. The fiber optic cables and the lasers that send light through them to move that data from the cell tower across the country and around the world.
So as the carriers see success and invest more in their networks to handle the 616,000 new users and all the new broadband customers, they have to buy new, better equipment from these vendors.
That's the thesis. It's a longer cycle benefit. It doesn't happen overnight. But a healthy carrier market ultimately leads to more spending on the underlying network infrastructure.
And the tickers provided for this category.
We have CIEN for Ciena, they're a big player in optical networking, and CSCO for Cisco, a giant in networking and routing equipment.
Ciena and Cisco. Okay, so that covers the potential winners,
Yeah.
big carriers themselves, the tower companies, and the equipment makers.
A fairly logical chain of beneficiaries.
Now, we have to look at the other side of the coin. Every action has an equal and opposite reaction. The losers. Who takes a hit when Verizon resets the market like this?
Right, because that growth has to come from somewhere.
Yeah.
And the first category here, not surprisingly, involves the wireless competitors.
Okay, wait a minute. We just listed AT&T as a potential winner. How can they also be in the loser category? This seems contradictory.
It is a nuanced situation, and it's a perfect example of how these things are not black and white. AT&T and the other competitors can appear in both lists. It all depends on the specific context you're viewing it through.
So as a loser, or at least as a company facing a new risk, what's the rationale?
The rationale is direct exposure to that promotional escalation and the resulting margin pressure we discussed.
This goes right back to the price war discussion.
Exactly. The mechanism is very clear. If Verizon pushes hard to win share, its peers, like AT&T and T-Mobile, often have no choice but to respond with their own promotions. They have to protect their flank.
And that costs money.
A lot of money.
Yeah.
And this can compress industry ARPU, that's average revenue per user, and EBITDA, which is a measure of profitability. So even if they manage to hold on to their subscriber counts, their profitability per user might fall.
So to put it simply, while AT&T might benefit from the broad sentiment that the sector is stable, they also face the direct, tangible threat of having to spend more money just to keep up with Verizon's new aggression.
You've got it. It's a positive for sentiment, but a negative for near-term operational and financial pressure.
And T-Mobile is obviously in this group as well.
Oh, absolutely. They are front and center. So the tickers here are TMUS for T-Mobile, and again, T for AT&T. You have to remember, T-Mobile has been the primary growth engine in this industry for a long time. They were the ones taking share.
They were the aggressor.
They were. So if Verizon is suddenly taking share again, that share has to come from somewhere. It either comes from T-Mobile, or at the very least, it makes T-Mobile's future growth harder and more expensive to come by. It forces them to fight a two-front war.
Okay, that makes sense. Let's move to the second category of losers. Cable MVNOs.
Right. This refers to the cable companies that have gotten into the mobile phone business. They sell mobile services, often bundled with their home internet and TV packages.
Like when your cable provider, the company you get your internet from, offers you a cell phone plan, usually at a discount.
That's the one. The rationale here is the inherent vulnerability of these mobile services that are sold via cable bundles.
What's the specific mechanism that hurts them in this scenario?
Well, more aggressive pricing and retention efforts from a behemoth like Verizon can dramatically raise the acquisition costs for these cable MVNOs. You have to remember, the cable companies don't own their own nationwide wireless network.
They rent it, right. They're an MVNO, a mobile virtual network operator.
Exactly. They lease capacity from one of the big carriers, often Verizon, in fact. Their whole business model relies on being a cheaper, more convenient option for their existing home internet customers.
The bundle and save play.
Right. But if Verizon suddenly starts offering better prices or much better subsidies on the newest iPhone, the value proposition of that cable bundle weakens. The price gap narrows.
So the outcome for them is a potential slowing of their mobile net adds. The growth they've been seeing could hit a wall.
Correct. Especially among the most price-sensitive customers, who are exactly the ones they target. Those customers might be lured away by a shiny new offer from a major carrier that now looks just as affordable.
So the companies to watch here, the big cable players.
The two big ones are CMCSA for Comcast, which operates Xfinity Mobile, and CHTR for Charter, which runs Spectrum Mobile.
Comcast and Charter. Got it. And finally, the third category of losers.
This would be the smaller or leveraged operators.
So these are the players with the least room for error, the much smaller wireless carriers.
That's right. And the rationale for them being at risk is pretty straightforward. Balance sheet constraints.
Meaning they just don't have the cash to fight a prolonged price war?
They don't have the war chest, exactly. The mechanism here is simple economics. When the big three, Verizon, T-Mobile, and AT&T, all increase their promotions and marketing spend,
The smaller operators get squeezed.
they get squeezed hard, they face higher churn because their customers are constantly being bombarded with better deals to switch. But the smaller players face much tougher economics when it comes to things like device subsidies and marketing spend.
They simply can't afford to give everyone a free $1,000 iPhone the way Verizon can.
They can't. They don't have the scale, the purchasing power with device manufacturers, or the access to cheap capital. So they're stuck between a rock and a hard place. Either they spend money, they don't have to compete, or they stand by and watch their customers leave.
So the outcome is just immense stress on their already tight balance sheets.
It creates a squeeze that can be very, very difficult to manage. For some, it can become an existential threat if the promotional environment stays hot for too long.
And which tickers fall into this vulnerable position?
The two mentioned are SATS for EchoStar, which now includes E-H network, and USM for US Cellular.
EchoStar and US Cellular.
Yes, players who are trying to compete but just don't have the same scale or financial firepower as the big three.
That brings us to the end of our breakdown then. It's really a comprehensive look. We've covered the numbers from the report, the idea of a strategic reset from Verizon, and then how this one event creates a distinct set of potential winners and losers across the entire telecom landscape.
It's a classic case study. It shows how a singular earnings report from a market leader can force a reevaluation of an entire sector's dynamics. It's not just about Verizon stock. It's about everyone they touch.
A really thorough examination. Before we sign off, though, we must state our final disclaimer.
Indeed, this is very important. Please remember that all the content we've discussed today is for informational and educational purposes only. It is not financial advice.
We are not financial advisors. There are no buy or sell recommendations included in this conversation, either explicitly or implicitly.
Absolutely not. This content represents purely the opinion of the author of the original material we've analyzed. You should always do your own research and consult with a qualified financial professional before making any investment decisions.
Your capital is your responsibility.
Well said.
Thanks. Thanks for listening to Breaking News to Trading Moves. We'll see you next time.